an underrated part of being a smart investor has nothing to do with numbers. Instead, it's everything to do with understanding your own brain and how it will try to trip you up. So now I want to walk you through some of the biggest traps I see people fall into, 7 of them, to be precise, so that you can avoid them. So welcome to Making Sense. It's the podcast for people who want financial freedom without giving up their coffee. I'm Frances Cook, a financial journalist and fellow financial freedom seeker who makes money simple for you. And this was originally part of my Market Memo newsletter, where I teach you about the share market for free every week. So first of all, make sure you're subscribed to this podcast wherever you're listening so that you never miss a trick with your money. But then skip on over to the Market Memo so that you also get my newsletter in your inbox every week. Just start smashing this money game, and I'll link it in the podcast description. But this was one of my newsletters that got such a big response. And I think it's because these mental traps with investing, they're a bigger problem than ever and really only getting worse. It is easier than ever to become an investor. Yay! But the very forces making it easier to invest can also make it easier for us to fall into some behavioral finance traps, which, boo. Every hour, your phone is lighting up with notifications, headlines, and hot takes. Markets are up and markets are down, and someone on social media just bought a stock that's definitely going to the moon. And if you're tempted, you can act on those impulses with a single swipe. That flood of information, combined with how easy it is to trade, has made investing, while it's easier to do it, it's also a full-time psychological challenge. So I genuinely believe that often your biggest money threat is your own brain. So time to rip through 7 of the most common mental traps that trip investors up. And, of course, what helps us avoid them. First up, loss aversion. The pain hits harder than the pleasure. Now, the problem here, we feel losses about twice as strongly as we feel the pleasure of a gain. When share market prices go down, that pain signal fires immediately, pushing us to sell before things maybe get worse. But by the time you've felt that panic, the worst is often already over. And selling just locks in that loss and locks you out of any recovery. So what helps here? Well, knowledge is power. Doing exactly what you're doing now, listening to financial content from people you hopefully trust, makes sure you're getting information that reminds you how markets work and that they historically recover given time. Some investors also find it useful to automate regular contributions so that emotion doesn't have a chance to interrupt the plan. If you create a plan in advance that includes the possibility of the market going down, you don't feel as much of an urge to panic and react. 2, overconfidence bias, the I can time the market illusion. The problem here, look, we all love to feel like we're special, and we're definitely all special to our mums. We all like to feel like we have inside knowledge. And so we can make deals that nobody else sees coming, which would be nice and all. And yes, we are all special to our mums, but usually when it comes to our money, that instinct that we're special is wrong and causes us to actually lose money. Now, one of my money superpowers is knowing that I am not the exception. I am bog standard. I am just like everybody else. And it really has saved my bacon so many times. Just keeping myself humble has made me a lot of money. The internet is full of charts and podcasts and opinions convincing us that if we just study hard enough, we can outsmart the professionals. But if you've watched my stuff in the past, you probably already know how I feel on this. It's pretty unlikely to happen. In fact, many professionals are beaten by lazy, automated investing strategies built for hitting the average. So what helps instead? One tactic is to put guardrails around yourself from the beginning. For instance, automating investments, using funds such as index funds instead of picking individual companies, Only checking in on your investments once a month or once a quarter can also stop you from making emotional decisions based on one bad day. And remind yourself that being average is good. Embrace it. It will probably make you a lot more money once you accept that and start to work with it. 3, herd behavior and FOMO. When everyone's buying, beware. The problem here, being a herd creature is great when we're organizing a brunch meetup. Terrible when we're organizing our money. Heard a stand-up comedian once. Can't remember which one. Sorry. If you know who this is, drop it in the comments. But he said if you drop a human into the middle of the jungle, you've just fed the animals. But if you drop 10 humans in, you've just dropped in an apex predator. And I know they were being funny, but that's so true. Humanity's great strength is our ability to work together. And that is what our wiring is built for. But it also has a very real downside in that we are so wired for that, and it can mess with your money. It messes with your perception of where the risk and reward is. If a particular stock, fund, or sector suddenly shoots up, it can feel like you're in danger of being the only one left behind. The trouble is, the crowd often arrives just as the music stops. Momentum fades, prices stall, and late arrivals are left paying the bill, not pocketing the profits. So what helps here? Well, before buying anything, some investors find it quite grounding to write down why they want it, what role it plays in their portfolio, and how long they plan to hold it. It is amazing when you force yourself to put pen to paper and in black and white, plotting down the motivation, you find yourself admitting, this is FOMO, not a financial plan. 4, home bias. Comfort can cost you. The problem here, we tend to stick with what feels familiar, which might be local companies, property close to home, or even just name brands that we've seen around. But that home bias can cost you money, as one of the greatest benefits of the share market is ease of access to all of the opportunities throughout the global economy. You don't want to end up overexposed to just one country's economy or one particular industry. Because here is a wild fact. Our local share market here in New Zealand makes up 0.1% of the global market. So if you put most of your eggs here, that can mean missing out on entire industries and regions and growth stories overseas. So what helps on this? Well, let's get in on some of that US tech, British finance, or Japanese manufacturing. Some people invest through a global fund, or they just check the product disclosure statement for funds they're looking at to see how globally spread it is. Spreading across different countries, sectors, and currencies helps smooth the bumps when one part of the world hits a rough patch, which happens. 5, confirmation bias, the echo chamber effect. The problem here, once we've made a decision, we naturally look for proof that we were right. We follow commenters who share our views. We ignore opposing evidence. We click like on anything that tells us that our choice was smart. Unfortunately, markets don't reward ego. They reward reality. And sometimes the facts that we use to make that decision can change. So what helps instead? Many people find it useful to deliberately read 1 or 2 credible sources that disagree with their position. You don't have to change your mind. Just deliberately look for those opposing views and be genuinely open to their argument. It's useful. You can take in information and then still disagree and move on, but just make sure you've seen it first. Then ongoing decisions stay anchored in facts instead of pride. All right, 6, we're on to 2 hands now. Recency or familiarity bias. Thinking yesterday predicts tomorrow. The problem here, we get utterly bogged down in whatever's happening right now and think that's the way it's going to continue forever. When you'll know if you've listened to my other investing rants, the trick to making money is always taking the long-term view. Recency bias means when markets have been falling, it feels like they'll never rise again. And when they've been soaring, it feels like they'll never stop. We're wired to believe that whatever just happened will keep happening. That makes it hard to stick with a long-term plan when short-term swings feel so real. So what helps instead? Many people will create an auto-invest strategy and then have set check-in times, possibly 4 times a year. This can stop you overreacting as events happen in real time, putting in some distance so that decisions stay grounded instead of emotional. All right, lucky last. 7, present bias, the now trap. Now, despite the similar wording, this is different from recency bias, so stick with me here. The problem on this one, we've all been battling this since we were kids. It just feels better to do something that gives a reward now instead of later. Spending today feels more satisfying than saving for a future we can't quite picture. In investing, present bias can show up as delaying that first deposit or pulling money out the moment markets wobble. This one is less about what you think is going to happen and more about the reward you're wanting and wanting that reward quickly. So what helps? I'm sorry to keep banging this drum, but automation can once again help you out here. It's just a really good hack. Decide on an amount that can fit your budget, whether that's $5 a week, $50 or $500, whatever. Setting up whatever regular transfer that you can stick with and timing it for maybe the day after each payday stops willpower from hurting you. Because honestly, when did willpower last work out long term? Automation, far more reliable. You don't have to suppress all of your emotions to be a successful investor. You just need to stop them from driving the car. That's why it's useful to know that these big mental traps can turn up and the tactics that can stop them from totally derailing you. Frankly, sometimes just knowing what they are means you'll be able to see them happening to you in real time. And you just stop yourself at the right moment and go, aha, I know what that is, and that even has a name. So if this helped you out, then of course hit subscribe, but then also send this episode to a friend so we can all level up with money together. Until next time, have a great day. Just a note before you go, this podcast can only give you general information about how things work in most cases. It's not individual financial advice. We're all different, so some of this might not apply to your specific situation. Take what works for you, ignore the rest. If you're after individual financial advice, a financial advisor is always the best bet.